And hello, everybody. Thank you for joining this week's Wednesday webinar, the 5-Minute Brainstorm. Every week, we're doing a 5-minute webinar to talk about a hot topic, a topic of relevance to you in your business and even in your life. We hope that on these sessions, you'll be able to walk away with information and tools that you can put to work in your business and in your life. Today's topic is strategies to pay for long-term care without insurance. I'm Chris Orestes, and thank you so much for joining us today. So let's start with the obvious. Long-term care is an expensive proposition. Costs of care on a national average in 2020 was for home care $4,500 a month, assisted living $4,300 a month, and for a nursing home $8,000 a month. Those are costs that if the individual or family needs to bear them on their own, there are not a lot of people who could sustain that for months, if not years at a time. The problem is people are not well informed and they're not well prepared for the realities of long-term care. It's a subject that people want to avoid. They're not really well informed about the costs or how to pay for it. There's a lot of confusion thinking that health insurance will pay for it, or Medicare is going to pay for it, or Social Security is going to pay for it. Somebody's going to pay for it. There's also a lot of confusion about the different types of care and what's covered, what's not. Nursing home care versus assisted living care versus home care versus memory care. Does Medicare cover it? Does Medicaid cover it? What is and what isn't covered? What will insurance policies cover? For a lot of people, they're just not well informed. They've avoided this topic. They don't want to talk about it. It's unpleasant. It's unpleasant to think about needing it for yourself or needing it for your loved one. And for most people, they just avoid it until all of a sudden they find themselves in a difficult situation, and then they're scrambling for information and resources on how will they navigate the system. Medicare and health insurance do not cover senior living and long-term care. Medicare will only cover 100 days of rehabilitation care in a nursing home. Medicaid has very stringent spend down, income asset limitations, and once you get onto Medicaid, you're going to find that your care options are quite restricted. Where you go, what you would get in terms of moving into a nursing home, you're not going to get a private room. You're going to get probably sharing a room with one or two or more people. Private pay really is the only option that will allow you to control your care decisions and provide financial protection for your family. But the challenge for private pay is for a small group of people in this country, they can afford to just pay cash. They're the wealthy, and so those monthly costs and quite frankly even more in a lot of circumstances, a lot of environments for care are going to be quite expensive, but they have no problem self-insuring, paying for it themselves. And then there's a rather large segment of the population. Over 70 million Americans are on Medicaid, and they qualify because their income and asset levels are below the poverty levels that will qualify you for Medicaid. But there's that big middle class bulge right there in the middle of people. They're not rich enough and they're not poor enough, so they're caught in sort of a uncomfortable situation for themselves and their families, where they start to scramble to figure out, how do we pay for care? Well, what we want to do is spend some time talking about private pay options that are immediately available to people when they have a need for care. Some people may have long-term care insurance. There's less than 8 million in-force long-term care insurance policies in this country today. But for a lot of people, whether they do or don't have a long-term care insurance policy, there's a range of private pay options that are well suited to their age and their health condition at the time they need care, that they should be aware of and able to access. Let's start with your home equity. You can look at taking a home equity line of credit with a bank, a HELOC, that will allow you to draw down off of your home and pay out as you go, as you need towards your cost of care, whether it's in home or out of the home. Let's say you move into an assisted living community or a memory care center, something like that. Now, another way to access your home equity is through a home equity conversion mortgage, or what's known as a reverse mortgage. This allows you to take down your equity in the home and use it towards expenses. You can take it as income, you can take it as a lump sum, you can set it up as a line of credit and use it towards any expenses that you want. The only catch and sort of drawback to a reverse mortgage in a long-term care situation is you have to be residing in the home. If you leave the home, then the reverse mortgage is due in full and it immediately has to be paid back, which oftentimes means the sale of the home. So you have a couple of ways to draw on home equity and pretty readily available and pretty immediately available if the circumstances are right for drawing on your equity in the home. Another option that many people have taken over the years is the VA aid and attendance benefit. This is a monthly benefit paid to veterans of an active period of war, either to themselves as an individual, together as a couple, or even to a surviving spouse. This is a particularly common method that we've seen over the years for people to move into an assisted living community. If you're a single veteran, you can, and you qualify for the Veterans Aid and Attendance Benefit, you can receive, as of 2021, $1,936 a month paid towards your care. As a couple, $2,295 a month. And if there's a surviving spouse, then that surviving spouse can access $1,244 a month towards long-term care, assisted living, home care services. Another option that people can look to are senior bridge loans. These are loans specifically designed for seniors to access money in a short time frame that they would use, typically again to pay towards assisted living. It's a co-signed loan by family members that's used typically to pay entrance fees and monthly fees for assisted living. They tend to be about a 12-month time frame and can range between $50,000 and $500,000, and are used to bridge a time frame between the need for care and accessing a more long-term financial solution. Maybe that's equity in a home, sale of a home. Maybe it's liquidating other assets, tapping into other sources. Could also, we've seen it used as a bridge or combined with a life settlement as another tool to pay for care. Speaking of life settlement, last but not least is life settlements. Long-term care life settlements are a tax-free way to pay for an immediate need for care. To qualify for a tax-free long-term care settlement, you would need 2 ADLs or more, or have under 2 years of remaining life expectancy. You would either need to be chronic or terminal to trigger the HIPAA exemption for tax treatment for a life settlement. You have then the option to take a lump sum settlement, or for many people, they'll take that settlement and they'll put it into what's known as a long-term care benefit account. This is a protected, irrevocable bank account, kind of like an HSA, where the money goes in to then be used to pay for any care services that the account holder wants at whatever amount they need on a monthly basis. Now, if the account holder passes away before spending all the money that's in the account, then that balance in the account would actually transfer to whoever they would name as the account beneficiary, which can be one or more people. This is also a Medicaid qualified spend down of the insurance asset. Let's remember, life insurance policies are not qualified assets for Medicaid eligibility and require either surrendering the policy for cash value and spending that down on your care, or selling the policy for its market value through a life settlement and spending that money down towards care. So if somebody uses a life settlement, funds a long-term care benefit account, that funds their care needs for 1, 2, 3 years, they spend the account down to nothing, they would then be able to make a seamless transition over to Medicaid to take over those monthly payments. So for people who haven't adequately planned for long-term care, there's a number of mainstream private pay options that can supplement their cost of care, whether it's a combination. These various private pay tools can be used in combination with each other, with long-term care insurance, or any one of them might be your sole solution to putting yourself in a position where you can access private pay dollars to maintain choice and control over what's going to happen in your long-term care environment. Home care, assisted living, memory care, nursing home care, all of these solutions are tools to put you in a position to be in charge of where you're going to go, what kind of care you're going to receive, and protect your family from being financially burdened by the situation as well. So I want to thank you all so much for joining us for this week's 5-Minute Brainstorm, strategies on how to pay for long-term care without insurance. Be sure to join us every week on Wednesday, where we repeat 3 o'clock Eastern, 5-Minute Brainstorm, a new topic, new information, new set of tools for you to take into your practice. We thank you so much for joining us today, and we look forward to when we will talk to you again next week. I'm Chris Orestes. Thank you for joining.